This video is sponsored by The Daily Upside, more on them later in the video.
They probably have as high an average IQ as any 16 people working together in one business in the country. The whole story is really fascinating. If I ever write a book, it's going to be called Why Smart People Do Dumb Things.
In the mid-1990s, the Wall Street equivalent of an NBA All-Star team was assembled to launch a hedge fund.
Future Nobel winners Myron Scholes and Robert Merton, and three of the brightest mathematical minds in the world.
They used an undisclosed trading strategy to deliver staggering profits for its clients over a 4-year period. But in the 5th year, the fund entered a death spiral. Losses so violent that they threatened to take down the entire financial system.
Had the failure of LTCM triggered the seizing up of markets, substantial damage could have been inflicted on many market participants and could have potentially impaired the economies of many nations, including our own.
This insane 5-year rollercoaster began in 1994. A hedge fund called Long-Term Capital Management begins trading money for its clients. Among them are wealthy individuals, institutions, and even foreign governments. And collectively, they hand over more than $1 billion to the firm. Only the insiders of the fund know the exact trading methods they'll use to grow that money. But that didn't matter to the clients because the results were speaking for themselves. In May of that year alone, they generated a 7% profit, and by year end, a return of 28% before fees. A year, by the way, in which the stock market broadly was down. The market bounced back with a 34% gain the following year, but it had nothing on long-term capital management, a 59% gain, and had now grown $1.25 billion of starting capital into $3.6 billion in just 2 years. Year 3 was an equally impressive 57% return, followed by 25% in 1997. In October, 2 of the hedge fund's partners, Robert Merton and Myron Scholes, were awarded the Nobel Prize in Economic Sciences for developing one of the most important formulas in financial markets. The Black-Scholes model, a way to determine the value of derivative securities such as options or futures contracts. The incredible irony is that it was a misapplication of derivatives prices that made 1997 the last profitable year for the fund. Within 6 months, long-term capital management imploded, dropping 6.7% in May, another 10% in June, and it just got worse and worse. On August 21st alone, they lost $500 million, and by the end of that month, they'd set fire to nearly all of the $5 billion they were managing for clients. The New York Fed president needs to be briefed on the situation, and what he sees behind the curtains is horrific. The remaining $2.3 billion of clients' money was leveraged at a ratio of 55 to 1. The hedge fund was about to default on more than $100 billion of debt. Money that had been lent out to more than 50 financial institutions, and with some of the loosest loan terms he'd ever seen. This wasn't going to be an isolated collapse. It had the potential to cause a domino of defaults and losses all across Wall Street. This might be the craziest story I've come across, and I'm going to show you the inner workings of this hedge fund. From the specific trading strategies they used, the disastrous mistakes they made, and the negligence of Wall Street who poured gasoline on the long-term capital management fire. Many of the baffling details of this story come from Roger Lowenstein's book, When Genius Failed, so all credit to him and his incredible journalism. Before we continue, I just want to pause the video and share with you an incredible free resource for staying up to date with the business world. The sponsor of today's video, The Daily Upside. They're a completely free daily newsletter with over 1 million investors subscribed, including myself. It's really easy to sign up, and with just 5 minutes each morning, you'll be able to get up to speed with the top finance and investing news, including insights, analysis, and clarity on the top business stories circling the globe. I've been a long time and avid reader of the Daily Upside, not only because it helps me to stay up to date, but because their stories always include unique details that I just don't find in traditional media, such as this fascinating analysis of consumer spending they shared in one of last week's publications. Again, it's completely free to sign up, and you get one information-filled email each morning. Join over 1 million people who trust the Daily Upside and sign up using the link in the description. Okay, so right at the center of this story is John Meriwether, the founder of Long-Term Capital Management. He's the man who was able to bring so many prominent figures from finance and academia together to manage money. And their main trading strategy was discovered by Meriwether in 1979, kind of by accident. He was a trader at Salomon Brothers, running a fixed income arbitrage group that he'd started 2 years earlier. One day in the middle of June, he received a phone call from John Eckstein, another trader from outside the firm. He told Meriwether that he was on the brink of bankruptcy, all because he was stuck in a treasury bond arbitrage trade. Eckstein needed Meriwether to buy him out of his bet, but this was no small ask. This would mean convincing the Salomon Brothers executives to allocate tens of millions of dollars to a single trade, a sizable percentage of the firm's $200 million of capital. Meriwether explained the trade to his bosses. It would involve buying US Treasury bills and at the same time short selling the futures contracts of Treasury bills. The profit opportunity was the tiny difference in price between the futures and the actual bonds. Effectively, the trade would make money if the two prices converged. Hence, it's called a convergence arbitrage. Surprisingly, the Salomon leaders gave him the all clear, although the managing partner set a contingency. If the trade didn't work, you'll be fired, he told Meriwether. This was a light bulb moment for Meriwether. That convergence arbitrage strategy would become the exact blueprint for his own hedge fund, Long-Term Capital Management. And luckily, the trade worked, so he wasn't fired. Or more accurately, he wasn't fired that year. He was actually fired in 1991. Another Salomon trader, Paul Moser, confessed to Meriwether that he had illegally rigged a US Treasury auction by submitting fake bids. This is obviously a crime, but it wasn't reported to law enforcement. The Salomon executives decided to handle it internally. This was based partially on the recommendation of Meriwether, who believed it was a one-time mistake. It turned out that Moser had in fact violated Treasury auction laws repeatedly, and in August 1991, it was exposed. Moser went to prison, and Salomon was fined $190 million. The CEO resigned and was temporarily replaced by Warren Buffett, who had recently acquired a 12% stake in the firm. Shortly thereafter, Meriwether was forced to resign. A decision that fostered resentment of Buffett among the Salomon traders. Although, as it pertains to this story of long-term capital, Warren would ultimately have the last laugh. Starting this video with the words of Warren Buffett was no accident. The man unanimously known as the greatest investor of all time appears repeatedly throughout this story. Out of a job, Meriwether looks to start his very own hedge fund, and in 1993, he began assembling what could only be described as the dream team of Wall Street. It starts with a number of ex-Salomon traders: Eric Rosenfeld, Victor Haghani, Greg Hawkins, and Larry Hillebrands, among others. He then sought to recruit the very best from academia, starting with Robert C. Merton, a legendary figure in the finance world because of his research on one of the most important unsolved problems in markets: how to correctly price a stock option contract. The problem was already being tackled by two other genius economists, Fisher Black and Myron Scholes. They'd mostly cracked it, but Merton arrived on scene in the 70s and completed the formula. Black and Scholes published their findings first, and so it was named the Black-Scholes model. If you've been to business school, then you know just how big of a discovery this was for the investment banking world. It's like Einstein's E = mc², but for investment with risk. Scholes and Merton would both win the 1997 Nobel Prize in economics for it. But back in '93, they joined Long-Term Capital Management as partners and on the board of directors. And a few months later, they'd recruit David W. Mullins, former vice chairman of the US Federal Reserve, the second highest position at the Fed. What's important about this all-star lineup was the level of prestige it gave them. It was really great for getting early investment, but it also led many banks to overestimate their abilities, something that would create huge problems in the future. Merriweather approached Merrill Lynch, an investment bank who would help raise the initial capital for the fund. Merriweather's goal was to raise $2.5 billion, way more than the $25 to $50 million that is typical for a hedge fund launch. Acting as the placement agent, Merrill Lynch hosted a global fundraising roadshow in late 1993. The pitch to prospective clients was that long-term capital could exploit relative value opportunities in the bond market. The partners would charge a 2% fee on assets as well as 25% of profits, a lot higher than the typical structure of a 1% fee and 20% of profits. Clients would also have to have their money locked in for 3 years, another atypical feature for a fund. But this certainly didn't diminish the huge amount of interest for people wanting to have their money managed by such an all-star lineup. Investment poured into the fund from wealthy individuals, and a few institutions put up over $100 million each. Sumitomo Bank in Japan, Dresdner Bank in Germany, Julius Baer in Switzerland, and even the investment agency of the Italian Treasury. Not everyone was convinced. Merriweather traveled to Omaha for a dinner with Warren Buffett. He swiftly declined to invest. All up, they'd raised about $1.25 billion. The partners themselves put $146 million of their own money into the fund, and by 1994, they were ready to begin trading. In February, Fed Chair Alan Greenspan raised interest rates for the first time in 5 years. It triggered a global bond sell-off, and long-term capital noticed something unusual about the yields on the 30-year Treasury bond. In August, a brand new 30-year bond had a yield of 7.24%, but the exact same bond that was issued 6 months earlier was at 7.36%. The yield and price of a bond are an inverse relationship, so the slightly older 30-year bond was cheaper than the new one. It wasn't cheaper because it was a riskier investment, it was cheaper because of liquidity. The higher amount of buying and selling activity in the newer bond made its price higher. Theoretically, both would eventually become the same price. Long-term capital was able to profit from the prices converging by taking both sides of the trade. They take $1 billion of their equity, the client's money, and they buy the older, cheaper 30-year bond. They then turn to an investment bank like Salomon Brothers and they say, hey, I want to borrow $1 billion of the new 30-year bond. Long-term capital sells the bond immediately, and the cash they receive from the sale is posted as collateral against the borrowed bonds. This is called a reverse repossession, or repo agreement. Let's say it takes 1 year for the prices to converge. At that point, long-term capital sells the old bond, they buy the new bond and return it to Salomon, and the profit they've made on a 0.12% yield conversion is about 1.2%. If that sounds like a whole lot of work for a pretty pathetic return, well, it is. Which is why long-term capital did things slightly differently. Instead of using their $1 billion of equity to buy the bonds, they put it in a money market account that earns 5.5%. They still do a reverse repo agreement with Salomon, but this time for $25 billion worth of bonds. And on the other side, they turn to JP Morgan. They borrow $25 billion, buy the old 30-year bond, and post the bond as collateral. That's a repo agreement. literally just the opposite side of the trade that they have with Solomon. Now the fund is leveraged 25 to 1, so when the bond yields converge and they unwind the repo agreements, instead of making 1.2%, they make 30%. And they didn't use any of their own capital in the trade. It sat in a money market account and earned another 5.5%, a total return of 35.5%. But leverage works both ways. If the yield spreads between their bets widened, the losses would be huge. So it was critical that Merriweather and the long-term capital team could accurately calculate the risks of their trades. This was the role of Merton and Scholes. In early 1995, they wrote a letter to clients with explicit calculations of the probability of various loss scenarios. They claimed that there was about a 10% chance of losing 10% of their money in any given year, and about a 2% chance of losing more than 20%. In other words, they thought it would take a once-in-50-year market event to cause big losses. That year, long-term capital continued with their convergence trades, making $600 million on a single trade of Italian government bonds and a 59% return for the year. 1996 was a 57% return. The fund had turned about $2 billion into nearly $6 billion in just 3 years. However, in 1997, the hedge fund's 4th year, they would make the first in a series of critical mistakes. By now, almost every investment bank on Wall Street was taking part in the bond arbitrage strategies that long-term capital had been relying on. Bond spreads had narrowed, and the profit opportunity just wasn't there anymore. So under the advice of Victor Haghani, the fund turned to the stock market. Haghani believed that the same type of convergence trade could be done with pairs of stocks. Volkswagen, for example, had 2 different types of shares, an ordinary share and a preference share that came with superior voting rights. The voting shares had a price 40% higher than the ordinary shares, so a trade could be set up to profit if that gap got smaller. This was a significant deviation from what the fund was doing in the bond market. Different issues of the exact same 30-year bond should theoretically be the same price, but in the case of Volkswagen stock, the voting shares are legitimately worth more than the ordinary, so there should be a gap in price, and to make matters worse, that gap is purely subjective. There isn't a formula to tell you how much in dollars a vote is worth. Haghani was effectively arguing that the 40% gap was so high that it must be excessive. But clearly these types of trades come with much more uncertainty, so surely they would only place small bets, right? Well, as Robert Lowenstein put it, like a man who pays for dinner with $100 bills and never asks for change, long-term capital management had lost the habit of moderation. The fund made about 15 of these paired share trades, and some of them were absurdly big bets. One bet was on the convergence of the share prices of Royal Dutch Petroleum and Shell Transportation of England. The trade was an eye-watering $2.3 billion. Just like the 30-year bond bets, they used leverage, but the Federal Reserve actually limits the amount of money that a hedge fund can borrow against stocks. So instead of actually buying shares in Shell, they'd go to an investment bank like Merrill Lynch. Merrill Lynch would buy the shares for them and write a contract called a return swap. This contract simply says that Merrill Lynch will pay long-term capital whatever profit it would have earned if they'd actually bought the stock. And if the stock declined, long-term would have to pay Merrill. This effectively allowed the fund to sidestep any limitations on borrowing and to trade stocks without putting any money down as collateral. Merrill Lynch was one of long-term capital's biggest lenders, partly because the CEO, Daniel Tully, was family friends with Merriweather. Their families regularly played golf together. But it wasn't just one overly generous lender. More than 50 financial institutions were lending them money. And that year, 1997, long-term capital reached $1.25 trillion worth of these bets. The fund made a 25% return in 1997, about half of their 1995 and 96 performance. The fund had grown its equity so fast that they were having trouble finding enough profitable trades. The team ultimately decided to give $2.7 billion back to the clients, reducing the fund's equity to about $4.7 billion. And that is a decision they would come to regret. 1998 was the year everything you could possibly imagine going wrong went wrong. Market volatility was still high relative to historical norms, and so the fund positioned themselves with heavy bets on volatility declining. They also increased their yield spread bets in Brazilian and Russian debt, often taking unhedged directional bets instead of their usual arbitrages. If you believe in karma, then the trade that sealed the fate of the fund was its short against Berkshire Hathaway. Betting on the decline of Warren Buffett's company backfired spectacularly, losing the firm $150 million. In aggregate, long-term capital estimated that the fund risked losing $45 million for every 1% that volatility increased, but that a big spike was virtually impossible. Well, that theory would be tested in June of 1998. Solomon Smith Barney unexpectedly shuts down its bond arbitrage group and was forced to liquidate its positions. Equity volatility spiked from 19% to 27%, and within the space of a few days, the fund lost almost $300 million. A 10% monthly drop, now down 14% since the beginning of the year. Clearly, their calculation of risk had been wrong, and yet they continued to trust their modeling. It showed that the maximum daily loss had actually declined from 45 million to 34 million, so they doubled down on their bets. The fund's leverage grew to 31 times equity. As August rolled around, the fund's fate was all but sealed. The final nail in the coffin came on the 17th. Russia defaulted on its debt. Most investors thought this wasn't even possible because the debts were denominated in Russia's own currency. But instead of simply printing more currency, the Kremlin chose to pause its payments. Markets didn't really react to the news on that day because everyone just assumed that the global banks would step in to prevent a disaster. Well, they didn't. On the 21st of August, markets went into full-on panic. Long-term capital's Russian bond bets imploded, and the fund lost $553 million, 15% of all its capital in a single day. When markets closed for the weekend, long-term capital was in crisis mode. They couldn't exit their bets because there simply wasn't enough buyers in the market, and they couldn't just wait it out. At the current pace of losses, all their capital would be gone in a matter of days or even hours. They needed a capital injection, new investors to put more money into the fund. Eric Rosenfield calls Warren Buffett, asking him to buy out their positions. A somewhat embarrassing call to make, as only a few months had passed since they'd shorted his company. He declined to save the fund. Merriweather then met with George Soros and Stanley Druckenmiller over breakfast. They themselves had just lost $2 billion from Russian bond bets, but agreed to invest $500 million if they could secure another $500 million elsewhere. By the 25th, the firm's capital had dropped to just $2.7 billion. They tried getting additional investment from Merrill and Solomon Smith Barney, but both attempts failed. The 27th was long-term capital's second worst day ever, losing $277 million. By the 31st, just $2.28 billion remained, down 52% for the year. And with $125 billion of positions they couldn't get out of. 55-to-1 leverage, meaning a simple 1 to 2% decline in their portfolio would incinerate all of the remaining equity. On the 3rd of September, their Brazilian debt positions began to implode, just like their Russian bets. On the 10th, there was news of a rocket exploding on launch. It was carrying Globalstar satellites, and it just so happened that long-term capital owned a lot of the company's bonds. The fund's capital slipped below $2 billion. This was it. Long-term capital was going to run out of money. It's the 23rd of September. The CEOs of 14 major banks are sitting around the Federal Reserve's Wall Street boardroom. Fed President William McDonough lays out the urgency of the situation. Long-term capital had $1.25 trillion worth of derivatives positions. Every single bank in that room was owed billions of dollars, and when long-term capital collapses, each bank would be forced to sell huge amounts of stocks and bonds. A fire sale that would likely cause a chain reaction and collapse the entire stock market. McDonough urges the 14 banks to come together and inject $4 billion into long-term capital and save the system from a full-on financial crisis. This meeting in the 25th hour was an unprecedented collaboration that ultimately prevented a disaster. Collectively, the banks injected $3.65 billion in exchange for owning 90% of the fund. Bear Stearns ironically refused to contribute to the bailout. Less than a decade later, they'd happily take a $25 billion bailout for themselves. If this deal had fallen through, there was one other offer on the table. Warren Buffett came back with a last-minute bid in collaboration with AIG and Goldman Sachs. Buffett wanted the entire fund for $250 million, a 95% discount to what the fund was worth at the beginning of the year. Fortunately for the partners' egos, the deal wasn't necessary. The extra $4 billion of capital allowed long-term to survive while markets calmed down. Slowly, the fund's bets were unwound, and the banks ended up making a 10% return on the money they injected, which is such a perfect example of the risks that come with using leverage to trade. Long-term capital's models weren't wrong. Their bets made perfect sense, except for one thing. Markets are made up of people, and people act unpredictably. Markets can remain irrational longer than you can remain solvent. As the fund was rapidly approaching zero, they themselves were selling huge blocks of stock, driving prices to irrational extremes. So in the end, they were the ones taking the irrational actions that undermined their modeling. And if there's an ultimate lesson that's relevant to us today, it's this. Private investment firms are incredibly secretive about what they're actually doing. It's often invisible until it's too late. The most unusual part of all of this is that the long-term capital founder actually called the Fed before it imploded, an admission of defeat that likely saved the US from recession. The partners lost all of their money in the fund, but shockingly, most of their clients actually came out fine. Of the 100 wealthy investors, only 12 lost money, and just 6 lost more than $2 million. The fund had performed so exceptionally well in its early years that the internal rate of return was 19%, even after more than 90% of the fund was eviscerated in that final year. Hit subscribe if you enjoyed the video, and check out this playlist of my best videos if you'd like something to watch next. Thanks for watching.